Hi, welcome everyone. Thanks for tuning in to CAAMP TV, powered by TMG, the Mortgage Group. We're here live at the CAAMP 2012 Mortgage Forum, and we're here with a group of panelists, esteemed panelists, and today we have Kathy Gregory, President and CEO of Paradigm Quest, Rob McLister, Editor of Canadian Mortgage Trends, Jim Murphy, President and CEO of CAAMP, and Hallie Strandland, President of Fizgard Capital Corporation. Welcome everyone, thank you for joining me.
Thank you.
Thanks.
So, there's a lot of noise in the industry today, and probably the consumer doesn't necessarily know what all that means, but if you had to explain what's going on in the mortgage industry today to the general consumer, what would you say? And maybe Jim or Rob, do you want to pipe in to start here?
Well, I would say that you don't want to read too much into the headlines that you're seeing. As I said in the panel today, news that makes you feel nervous sells a lot more banner ads or whatnot than otherwise. And the fact is that there's a lot of great statistics out there that kind of tell the market the way it is. One of CAAMP's statistics that I've always remembered is that for people with 10% equity or less, there's only 25,000 of those people that would not be able to afford a 5% rate. Our market is so much more stable than you would expect from reading news stories, I would say.
I mean, obviously overall, we're still in a record low rate environment. So for a consumer that's wanting to buy a house or refinance, mortgage rates are still very, very low and obviously very, very affordable, which is what has created a lot of these regulatory issues in Ottawa, and concern about people taking on too much debt and household debt, and the impact of interest rates when and if they ever rise. So we've seen a lot of regulation changes in Canada, and the types of products that consumers can qualify for, what type of products are available to them. And it's our job all within the mortgage industry to, I think, educate decision makers on, like Rob is saying, the statistics, the real statistics about what's out there. We had a lot of that information here today at the conference. We had some great presentations by Merritt's Research, by our economists, just talking about the overall market. So, I think there's some concern out there in terms of some of the impact and the cumulative impact of all of these changes, and that's a concern we've expressed at CAAMP. But overall, as you look at the mortgage market in the country, it's rates are still low, and it's very affordable.
I would just add, I actually feel quite strongly about the headlines and the press relative to the risks and the growing mortgage market, and the issue was really about consumer debt, and so much of that, of course, is taken up just by virtue of size in the mortgage market. But and so the government has accomplished what they wanted to do, and that was stop the growth and the trajectory of increasing housing prices. And so what they've done is exactly what they wanted to do. But what they failed to do is talk about consumer debt as it relates to unsecured lending, and that's really the risky debt that faces consumers, and that's not what we're talking about in the headlines. And we don't do a very good job of that in this industry as well. Present company accepted, if we want to take control and make sure the message is accurate and clear to the consumer and to anybody looking to come to this country to invest, we need our own publications to accurately report the information, and we don't have that. And so the magazines and the publications out there that the market turns to is not reflecting and reporting what we need them to do, and that's about responsible journalism as it relates to the mortgage market, and care about what the regular press are reporting in their headlines.
I think that's a really important point what Kathy's saying, which is that there's this insatiable appetite by the media for all things mortgage. I mean, you look at our two national newspapers this morning, the Globe and Mail and the Post, and they've got lead articles in both of them, writing about, Rob's got an article in there. There's a lot of, things that get coverage. If you look on their online sites, you find a lot of the commentary and comments are really about real estate stories or mortgage stories. There's hundreds of people comment on these stories, are very interested in them. We have an ownership rate in the country of 70%, so people have views on all these, but there's just a lot of interest on the media's part in what's going on, and talking to people and wanting to, make sure that there is a story there almost. And as was said today, we've got to get good news out and base things on fact and on data, as opposed to other things, that concerns that might be out there.
One quick point is that someone in the media once told me that the things that sell advertising are housing, currency, and cars. So there's only so much news that's out on housing at any given time. So I think a lot of times the media creates stories, not non-factual, but they create and then they embellish, and then it kind of feeds into the hype.
I completely agree with all what three of you said, but to add on to that, what I think that we miss, and what's probably too boring for the media to report, is that the media says, certain banks are leaving, all these different rule changes are happening. But there are a lot of mortgage products out there for the Canadian consumer that does not believe that they fit into the new guidelines, new rules. But where you see the benefit of the mortgage broker is they have access to those products. But we have to do a better job as an industry and as lenders of getting that message out there. It's so easy for the Canadian consumer to only hear all these changes that are happening, rule tightenings, lenders leaving, when in fact there's many lenders actually entering the marketplaces. There's many products that are available to these mortgage consumers that I think we have to do a better job of that.
Yeah, they definitely choose the statistics that fulfill their need,
Exactly.
not necessarily report all the statistics so you get a fair picture. Now, I guess since we're on the topic of headlines, big news today out of Ottawa, Mark Carney going to the Bank of England. Thoughts?
I would just repeat, I guess, what some of the economists were saying on our economic panel this morning. I think there may be more exciting opportunities, I think how they phrased it in England. The Bank of England is now having also responsibility for regulating of banks. And so probably Governor Carney sees that as a huge opportunity. I mean, things are pretty stable here in Canada. Let's just put our mortgage issues aside, which are obviously very important. But in terms of, you know, the overall interest rates are stable and inflation and these sorts of other issues. So I think probably in some ways he was looking for an opportunity. And there's lots of things that are happening in England. We have lots of really qualified people, lots of you know, deputy governors of the Bank of Canada, people in the Department of Finance who I think could step up to that job to be the next governor of the bank, and it is an important role, obviously, an important role for our industry, but I think he saw another opportunity that he wanted to take advantage of.
But again, that's another really good story. Someone leaving to go out into another country to do something else where, you know, we've got really good people, like you mentioned, Jim, that, you know, he was a leader and a voice of many. So they're still there, and I'm quite confident in the procedure everything that's in place today. So it'll be interesting to see who steps up and who's next, but again, it's just another really good story.
And he's garnished a lot of respect in the industry with his track record and being named to the Financial Stability Board and the track record that Canada has. But I think, Kathy, as you said, was that we still have the foundations in place. It's not just that one person creates the foundation, it's that Canada has built up this foundation.
Is that, I would say, well, good for him, and he was a great governor and did a tremendous job, I think, at managing our fiscal policies. But he, the question is who's going to replace him, and so, you know, he's done a good job at committing sort of the slower interest rate hikes and managing the economy. The big question for us is who's going to replace Carney.
Hopefully, someone of influence.
It'd probably be a non-event, to be honest with you. We saw the bond market today didn't really react that negatively, at least last time I looked. And the economy is just much bigger than one man. As much confidence as he gave to the market, you know, that aside.
True. Now, I guess the big headlines for us as an industry has been the CMHC changes more so than the past, since, I guess, July. How have you seen that impacting the industry and engagement?
We've had a busy week at CAAMP for a number of reasons, and one of those reasons is that we released a research report this week that's gotten a lot of media attention, and had a very good article on Rob's site. And what we looked at, it's really kind of a simulation. We looked at mortgages since 2010, high ratio mortgages, and our economist, our chief economist, Will Dunning, said because of the changes since 2010, and primarily the move from 35 to 30 and then 30 to 25, and the third he looked at was the qualification for the variable at the 5-year. That's had an impact about 17% of people, first-time buyers primarily, but high ratio mortgages who qualified in 2010 would not qualify today. And I think if you went to all of the mortgage insurers, CMHC, Genworth, Canada Guarantee, they'd probably think that the impact of these changes in terms of their own metrics would be in that, you know, range in terms of high ratio mortgages. So, you know, in terms of quantifying it, and, you know, the numbers are the numbers, the facts are the facts, and it's gotten a lot of publicity and a lot of attention, it's not, from our perspective, in a sort of an advocacy way, that any one of these changes necessarily that has an impact. It's the cumulative effect of all these things. So the 4 sets of mortgage insurance rule changes over 48 months, the changes in terms of lender underwriting guidelines for federally regulated institutions, what, you know, CMHC's ceiling of $600 billion and not increasing that. These all have an impact on the market, and just the oversight and regulation of the federal institutions, what's being required in terms of reporting and other things. So these are a lot of things that all come together and I think have an impact, as opposed to necessarily any one of them, but, you know, we have done some work now that shows there is a number that can be measured.
Well, there's an interesting point to be made there. I mean, there was a lot of press about the CMHC $600 billion cap. There's a lot of press around the July changes. Personally, I just don't feel as though there was any press around the OSFI B20. I mean, it's coming into play and it impacts a lot of people's business. Some it doesn't impact at all, but there's not really that education component. Do you feel there's a reason behind that?
Well, I think that most folks look at what they perceive to be the high-risk group, which is high-ratio borrowers, and that's where they focused on those particular rules, especially the first-time home buyer, which can be, you know, 35 to 50% of the market at any given time. And the folks that have 20% equity or more, they're assumed to be a little bit more stable. Maybe they won't be as affected by these B20 rules.
I think overall, the assumption, the impact is around 17%, but whomever I'm talking to, they're down sort of in the last 60 days, year over year, somewhere between 20 and 30%. So total volume production, adjusted for seasonality, and it is in a large part due to the slower housing market and the slower housing and the rule change, and the rule change in fact influenced the slower housing market in some way. But the most obvious that has come up is the amount of refinance activity that has dropped to virtually zero, and so it is what it is. But what they're not reporting, or what we're not thinking about, is the residual effect of that. The number one reason for refinancing is renovations, and it isn't debt consolidation and all the things that sort of make a story interesting on a headline. So when we're not renovating, then that sector slows down, and when that sector slows down, and so on and so forth. So refinance activity has virtually gone to a standstill in the last 60 or 90 days, and that hurts everybody's business. The flip side of that is it's creating a new market. Then there's a supply and demand issue. There is lots more demand for uninsurable mortgages, and there's not a lot of supply in the market. So new entrants are really taking a good close look at that. Ultimately, the borrower in that fringe and that credit criteria will pay more, but the whole point is there enough product, to Hallie's point, available to them, and there really isn't. And so there's this huge amount of demand, and we have basically 2 or 3 suppliers and lots of little guys, and I think that's the growth sector going forward. That's the market opportunities. How do we do a better job as lenders and attracting new investors to invest in these mortgages so that there is enough supply to keep the housing market buoyant?
There's another side of that too. So I don't want to address the lending side, but now let's address the broker side of it. I think it's been a big switch for brokers to have to realize that they can't just be pumping A deals through anymore. They have to get educated on what other products are out there, how to sell private deals or alternative deals, who these other lenders are. Excuse me. But it's a really important switch for them. They have to do a lot more research and learn exactly who's doing what and where they can get these deals done. But that's from a broker standpoint. What I found is before you go into a broker's office, they want to hear about your product. They want to hear about your product for 5 minutes, and then you got to tell me how to get this deal done. So when I go and talk to them, it's more of an education process than it is a product presentation. Big switch from a year ago. They need to know. They need to have more information.
Kelly, is that 20 to 30% all mortgages, or just high ratio, all lenders? Or?
All.
Really? That's significant.
For the people I'm talking to.
Yeah.
And CMHC, they'll tell you that they're down but virtually.
I think the projection was what, 15 to 20% originally?
When the federal government made all these changes, the number they used in their press release in June was 5% overall, right? It was, in fact, the messaging at the time was will have a minimum impact or a small impact, but they didn't split out what the impact would be on high ratio, which is significantly higher. Kathy's referring to the whole, and I agree on the refinancing. I also agree that there is such a thing as good mortgage debt. You can consolidate things or invest in your housing stock in terms of renovation and those sorts of things. But so that, the number in our report is actually confirming what all the insurers are thinking about their high ratio business for sure, and in fact it may be higher than that. We'll see. I think it's also important that what the spring market's going to be. We're, November, December in Canada aren't necessarily the busiest months in terms of housing, but we'll see where it is in March and April in terms of the spring market.
Do we have any stats on the alternative lenders right now and how their market share has gone up and down, and what's happened with them over the last couple months? Is there anything out there that CAAMP has?
I would just look at the Filogix numbers, and there's some of those that are doing well. You look at some of the, you look at Inequitable and Home Trust are both doing very well.
Well, and it's clear to me that, the negative news or whatever sells headlines, but the truth is that when brokers are here, they're here to educate themselves, which we talked about, but also they're looking for opportunities, and one opportunity saying that's presented itself is we need more suppliers for these alternative lending solutions, because there's going to be people that still want those funds. They still need the money. They still want to do the renovations. you see any other opportunities presenting themselves over the next 6 to 12 months that the brokers should educate themselves on?
I think Jim brought up an interesting issue, and you know, it's not just a broker issue, and it's not just a monoline issue. It's, you know, the first-time home buyer and high ratio market has shrunk, so that would lead you to believe the broker will then focus on having more opportunity to focus on the conventional market. But with the ceiling on insured mortgages, it's going to make it much more difficult for monolines to actually have access to conventional type pricing. Monolines only fund through the securitization market. That's where we get our funding from, and they get their funding from. The reality is that opportunity will shrink, or has shrunk, and certainly is capped at a certain level, predominantly because it's a low cost. You know, the insured CMB is a low cost of funds, and the banks gobbled a lot of that up. Instead of using their balance sheet, they used the CMB, and so therefore it's, you know, the government wants to reduce its exposure. What Flaherty probably isn't thinking about is treating all folks equal probably doesn't make sense, and ultimately will hit the consumer and will hit the broker, because we only have one access, we only have one source of funding, and that's through securitization. Only one way that we fund our mortgages, and now that's limited on the conventional side. We don't take deposits, banks do, so treating everybody equally in terms of how we share that cap is probably ineffective. And so does that mean, what does that mean for the consumer? It means that likely conventional mortgages will predominantly be funded through the big bank balance sheets, because there just isn't enough for the monolines, and that's unfortunate.
I guess the question then I would have to you, because we were talking a lot about regulation, and maybe we'll sort of try and move on from this a little bit, but it seems to be obviously the big factor right now. But, you know, if the regulator were here today, and Jim, you may have the strongest viewpoint on this, but what would you say to them, and what message would you like to get across? Maybe it's something that has changed over the past few days.
You know, our message in the spring and in our meetings with decision makers in Ottawa is that we thought the market was already slowing. And certainly here in BC, we saw some numbers in 2011 where things were leveling off a bit. That's certainly now the case here in the Lower Mainland, but also, as was said today, in Ontario and in the GTA, and both new sales and resales. And there's a connection there between those two markets and large metropolitan centers. You know, the government is walking this fine line in this tightrope, and they are concerned about household debt. They are concerned about when and if interest rates ever do rise, realizing we've been in this low rate environment for 4 years, and everybody who's going to renew a mortgage this year from 5 years ago is going to have a lower rate than they did 5 years ago. And they're also concerned, as Kathy has talked about, in terms of the overall mortgage insurance, and Flaherty's been very public about this in terms of the exposure of Canadians and Canadian taxpayers on that, which is why the ceiling of $600 billion is not being raised. At least I think that's why it is. But housing on the other side is an important economic contributor to this country. And you know, we've done some research that 16–70% of all the jobs between 2006 and 2011 were related to real estate, directly or indirectly. It's important. If your economy is slowing overall, as it is currently, what's going to fill that void? One of those things is housing. And so that's, for decision makers, it's hard. You got to, you know, have that balance of the two. But I think we thought the market was already slowing, and so it's interesting. As I say, we'll keep. You know, and the thing is, the data will keep coming out. You know, they all have the predetermined dates for the resale numbers and the new home sale numbers. So we'll continue to watch and monitor. And I do agree that there are some issues around first-time buyers. I think we've got to look at that market.
I think it's unfortunate that all the rules, as Kathy was alluding to, were targeted on a broad scale. Okay, because if you have, for example, let's look at the amortization rule. If you have someone that can qualify at a 25-year amortization, economically, if that's a good, strong borrower, economically, there's no justification to tell that person you can only have a 25-year amortization. If they take a 40-year amortization, or even interest only, which is what HELOCs are, and they allocate those funds to a better use, and most people, believe it or not, allocate funds economically to the highest use. There's an actual economic penalty to forcing everyone to have a 25-year amortization. I don't know what that is. I can't quantify it. I've never seen research on it, but obviously, simple logic would dictate. The government made these changes to temper the housing market as an alternative to monetary policy, and I think we all understand that there's definitely benefits to soft landings and whatnot, but there are all side effects, and unfortunately, I think it's going to be really hard to quantify what those side effects are, but they're there.
Well, and unfortunately, as well, it was mentioned in the economic panel today that sometimes the amortization is based on life goals, some other things they want to do with the money, or save, or have children going to school, and there's other uses of the funds besides just not wanting to make the maximum payment, for example. So when you talk about quantifying it, there's a lot of things that go on in someone's life that the reasons why they're doing it is not just to have less of a mortgage payment, but allocate those funds elsewhere. How is that affecting the economy in other places? And I find that it was really unfortunate that that wasn't, I don't know, drawn out or investigated a little further. I think there's huge impacts there.
So, sort of deviating slightly here, but again, another statistic, which it's the 25, where it seems like there's this comparison, and it seems to be at this conference, of this, Canada's at 25%, Australia's at 42%, and some people have had some opinion on this, but how do we, as an industry, and it's the association, it's the broker, it's the lender, it's the press, how do we work to get the consumer on board to increase that market share?
Well, I was saying earlier today when I mentioned this, we were talking before we came on, Michael Beckett said your brokers need to change their attitude. They need to change their attitude about professionalism, getting a very common message out, not just, depending on what company you're with, but a message about their value proposition, what they can do for the Canadian mortgage consumer. I don't think that we're doing a good enough job. And they really have to get out there and have some common message anyway, that they can have a use for them, especially right now at this time.
It's going to be interesting to see how the broker market evolves because, we talk about 6 in 10 people, again, another CAAMP stat, don't really have a good firm understanding of what a broker does. When they learn what brokers actually do, those people, I mean, it's going to be either brokers get me the best rate or they give me the best service and advice. And if you're a broker and you're not doing one of those two things, you're that guy caught in the middle, you're in trouble.
That's the whole value proposition. What are they bringing to the consumer besides best rate?
Well, and that's another point. So should brokers really be focusing or lenders and brokers be selling other products as well? Should they be offering value adds?
Well, I would actually say that that's a little bit like trying to take a brain surgeon and make him a dentist. Your core competency is sort of this wealth advice piece, and what's missing is that this mortgage broker industry is really isolated and really is, within itself. And so if you look at Australia, that mortgage broker industry works with the real estate industry. They go hand in hand, which makes perfect sense. I mean, there's a real estate transaction generally involved, and so expanding that to sort of a one-stop solution. How do brokers and the real estate industry in general sort of work more collaboratively, focusing on their core competency, which is the mortgage and the real estate transaction, and and the advice around that, whether it's owner-occupied or multiple rental properties. So I think they need to, as an industry, need to expand that and focus on what that value prop is and finding other ways to touch the consumer. The other thing that's inevitable, and we're sort of behind the 8 ball as a country relative to other countries, in particular the US, is this direct-to-consumer and this sort of internet presence, and it's going to happen. And people, a younger generation will be much more comfortable getting their mortgage and their mortgage advice over the internet. And so how will the broker industry compete with that? It's going to happen. And we don't have really the infrastructure here today in any organization to compete with. If a Quicken Loans came to Canada, the broker industry would be a big threat. And so they need to sort of think ahead, and how do we as brokers get to that consumer with our value prop over the internet in a technically advanced way.
Well, that's a very interesting point, because we saw the Australians, they talked a lot about it, whether it's social media, the web, they embrace it. They don't try and butt heads with it. They say, that's where the consumer's going, I will take that on. So where do you, I mean, that's one aspect of it, but where do you see technology taking the industry altogether?
I just wanted to comment, just on the other thing about Australia that I thought was interesting on the panel today was this whole idea of fee for service and providing professional advice and the discussion that's ongoing in Australia around that, which is to say a mortgage broker provides professional advice on the most important financial undertaking that someone takes in their lifetime, namely, buying a home or their mortgage. And there's something for that value of service, of expertise, of knowledge, of professionalism. And it's an interesting, I don't know, what the answer here is in Canada necessarily, but it's a very interesting discussion to have about providing that fee for service, because you're speaking to all these things about raising the bar and professionalism, and you know what, maybe that should also be quantified. It was an interesting point, I thought.
Be a big portion of the service provided by mortgage brokers that would disappear, the credit counseling. So even to some wealth management, to a certain extent, they're not financial planners. How is that going to be serviced over the internet? I know that there'll be a portion of the market that really doesn't care, and they're going to do whatever they want anyway, they do their own research. But that's something that I think would be really unfortunate to lose in the marketplace today.
I think the low-hanging fruit in the mortgage market is that AAA borrower that can get a mortgage anywhere. And if those type of people can go to an iTrade and do self-directed investing, pick stocks, which is like, well, I know I did 11 years, it's one of the hardest things that you can do. More than 9 out of 10 people don't beat the market. If people can pick their own stocks and think and believe that they can outperform the market, then they sure as heck can pick their own mortgage. And so it's going to be interesting to see with those extremely well-qualified borrowers if they gravitate more to an online model. I personally believe they will, and I don't know how fast. Maybe it'll take 2-3 years. I think the rate aggregator websites out there will drive this trend far faster than most of us believe, but it'll be something to watch.
I think we'd all agree, though, that I think we recognize that the mortgage broker industry is really losing that AAA client anyway. They can get them online, they can go to their bank, they don't really need the services of a mortgage broker. I think where their value is going to be is those that need some help, that need that one-on-one, face-to-face advice. So I completely agree with you that those AAA borrowers are going to be gone, they'll do it themselves. But we really need to make sure that mortgage brokers in our marketplace understand how to explain their value proposition, how to explain the credit counseling, how to prove their worth. It's not just best rate. So I completely agree with where you're going, and I know that we'll see some type of quick in or it comes down the pipe.
Don't say that too loud.
Yeah, but we'll see something, but we really need to focus on giving some tools to the Canadian mortgage broker for those other consumers.
There's probably only maybe, I don't know what the number is, but maybe 5%, 10%, what would you say the number is, of brokers that really have a good solid grasp of the alternative lending space?
But more importantly,
15,
what is the total
10,
opportunity
15?
for them? Is it 8% of the total market? 8% of the total origination market. So if in fact that was the case and mortgage brokers won't be able to sell the AAA, that's a lot of mortgage brokers for a small amount of Canadian consumers. So that's a long period of time, but it's just, there's just too many brokers for the amount of.
I think they recognize there probably already is.
Maybe.
I personally think there probably already is too many true blue professional mortgage brokers out there that can service not only that A client, but right through from A to the truly private stuff. You really need to know it all. It's not just those A deals anymore. You can't survive on that.
The number of licensed brokers across the country has actually been pretty stable the last couple of years, so it hasn't really increased. And we had this marked increase, obviously, before 2008, and the increase in the market share for the channel. But overall, it's been relatively stable. I even look at a province like Alberta, which has the strongest economy in the country, and you look at their relicensing that they just did the end of September, it was just flat.
Did it go down at all?
It went down marginally, maybe, but, and I say that for the fastest growing province. Ontario had a bigger drop. It'd be interesting to see what will happen here in British Columbia with a slower market, and people, renewing their licenses and looking at those sorts of things. So these are decisions people make.
And the point you made, though, is that in Australia, they embrace that direct-to-consumer evolution of that, and so, and they've done a pretty good job of doing it. We haven't done that as a broker industry yet, and so you can fight it, or you can find ways to service sort of that trend, and I think it's a great opportunity going forward.
And you all made a really good point, and probably my last topic that I'd like us to touch on before we wrap up here, but it's just the industry, yes, we're losing some individuals that can't seem to make it in this industry. Maybe they're taking on part-time work, or maybe it's just best that they're not engaged in the industry because they're not adding value anymore. But how do we as an industry make sure that we are adding good quality people to the industry that can tell the story well?
I was going to have Hallie who's on our foundation talk about our...
There's a couple of different initiatives, and I'll just touch on two really quickly since you guys have some others. CAAMP, for example, at this particular mortgage forum, Career Day yesterday in the Expo, where they brought in full-time students, university or college students, that ran a financial program. So they were able to come here and learn about our industry, see who the players are. So that was a really great initiative from CAAMP. What CAAMP Foundation also did this year, which some of us saw at lunch, was ran our first ever scholarship. It was a video scholarship. A student it was a full-time student, had to come in, have a 2 to 4 minute video about financial literacy and what was important to them, and of course why they deserved this award. It was a really interesting process. We had some great submissions, and it was the first time that we did it. But I think that is something that the CAAMP Foundation is going to continue to do, is to promote financial literacy and to bring in these students that are already involved, university, college level students, into the industry. So really qualified, interested people.
Jim, do you have anything to add to that?
We have a leadership program that will be launching fairly soon also through CAAMP, and Hallie's been very much involved in that along with Boris Mozek, our immediate past chair. So we're looking at that, and the whole idea, which the industry really strongly supports, which is raising the bar and professionalism, providing opportunities for people to learn, providing opportunities for people to mentor, so that they have people in the industry that they can look up to and learn from, which I think is important in this industry. So these initiatives, continue to build on that, and overall, also just I think we all have saying what the channel is in terms of a good career for people, and what it's about in building a life within the channel, and it's a great place to be, and I think we all have probably a better job to do on that also.
I think CAAMP's done a tremendous job at trying to change that professionalism of the broker industry, and it's a bit like pushing a rock up a hill of getting the industry to accept it and adopt the changes, but and a lot of it was spoken about today. It's, we need harmonization across every province. We need a title. We need to make the industry attractive as a career, and by doing that, make it well understood. So, single accreditation, the entry, the ability to enter this market shouldn't be simple, and you should really have accreditation that's tested and accepted, and so that people who are in university say that looks like a good career to me, because comes with the stigma of professionalism, and you'll attract a better quality of individual. And really, CAAMP has done made the professionalism assisted come a long way, but it's got a long way to go when every province is so different. And the more the industry resists all of the work and efforts that CAAMP is trying to invoke on the less likely it is it's going to be an attractive industry for young professionals.
I think that professionalism point is so important, because I think most people would agree that there's either enough or too many. I happen to think there's too many brokers in the industry, and it's too easy to get in. The barrier to entry is too low. I don't know what the answer is, but whether it's looking at the AMP accreditation and firming that up a bit, or imposing some type of mentorship requirement or training requirement, what have you, I don't know. But I think that we really need to tighten that up, because I'll tell you, I run a blog, I see people talking about mortgage brokers on a blog. One person puts a post on there, it's read by 100,000 people. That doesn't help the industry if it's a negative post. If it's positive, it's a great thing. But and to encourage professionalism, I think it all comes down to your weakest links.
And Rob, I talk to as many as I can investors outside of this country, and when they're doing due diligence on this market and this industry, they go to CAAMP and they go to these websites, and this is the stuff they read. And for me, it's embarrassing as a country that we would allow that sort of garbage in the media, because potential investors are looking and reading this and thinking, this is not exactly an industry that I may want to get involved with. So we allow it to happen. It's really it's shameful.
I have just 2 quick points to make. we do have an opportunity with the AMP, the Accredited Mortgage Professional. Right now we've got various names across the country, you know, sub-mortgage brokers, all these different things. We're not one thing, even though we're in the same industry, we're called many different things. But one of the things that we can do with the AMP, for example, is that's what we are, Accredited Mortgage Professionals. If we can get that message across, give it enough strength, some backbone, something that really means something, it's there. That could be what we are right across the country, whether you're in British Columbia, whether you're in Halifax. As long as we can get the regulators on side, give it some really true blue strength, I think there's an incredible opportunity there. It doesn't happen overnight. No accreditation does. We're halfway through a typical cycle, 15 years from getting an accreditation, really recognized even by our own membership, not just the public. So that's one thing. The other thing we touched on about blogs, websites. It's been a challenging few weeks, I can tell you that, on some of the websites that are out there, and not yours, which is fantastic. Absolutely fantastic. But it's like any other type of media. This is what the consumer sees, and they see some things. It's not People Magazine or the Inquirer. We need to support those websites and blogs that give the real, true, professional message come across, and the real goods, not sensationalism. And I plead all those in our industry to not support that. It's crap. It doesn't do any good for any one of us in the industry. It's really poor taste, and it's not okay. But I'm also hoping again that the opportunity with AMP, still hard work for CAAMP and your boards, but I know it can happen. But there's one thing, and an accredited mortgage professional right across the country.
I just want to pick up on Hallie's point. We had a board meeting here in Vancouver. We have quarterly board meetings, and we're actually doing our strategic plan this year as an association. And so we ran around our whole board, and everybody spoke for 5 minutes of what they thought were the priorities for the association, and obviously for the industry. And the whole issue of communications, and not only the materials and what you're saying, but how you're saying it, came up. It was a real focus of discussion by everybody. And I think that is an area we're going to focus on, and I think you'll be hearing some new things from us in that regard, because there's a lot of people who this subject is on their mind.
I totally see where you're coming from. So push professionalism is kind of the message that's coming across in all of that. Well, I want to thank all of my esteemed panelists for joining me today. I really appreciate you and your opinions here today, and I want to thank everyone for tuning in to CAAMP TV. We really appreciate it, and we'll see you again shortly.
Thanks, Dan.
Thanks, Dan.
Thanks, Dan.
Thanks, Dan.
Thanks, Dan.
What should I do with the money I earned over my summer job? Or how do I start saving for my first car? My first house? In every stage of our lives, we have different demanding financial needs, and staying on top of these needs is overwhelming, but it is definitely possible. The key? Financial literacy. Being financially literate means being able to make sound decisions based on financial knowledge. It means being able to manage the way you spend your money, and it all starts with an understanding of how finances directly impact our lives. As a university student, some things that keep me on my toes are tuition, textbook money, student fees, monthly rental, groceries, and the list goes on. So how do I manage my finances? Well, first, I keep a budget composed of discretionary and non-discretionary expenses. The non-discretionary expenses are the ones that I'm obliged to pay no matter what, like tuition. For me, with limited source of income, I limit my discretionary spendings to $20 a week, which I keep track of using an Excel spreadsheet and keeping all of my receipts and recording all of this information on my spreadsheet on a daily basis. Second, I save. Any extra money that I earn gets put aside in a tax-free savings account where I'm currently investing in mutual funds. This is an excellent way for me to earn interest on my savings, tax-free. So what are some tips for managing your own financial matters? Well, that really depends on your life stage and your financial goals. So start simple and set yourself some goals. What do you want to be able to accomplish in 1 year, 5 years, 10 years? Plan ahead for the future and be specific with your goals. For example, make it a goal to contribute a certain percentage of your monthly income to a savings account. Then commit. Assess whether you have the funds to start saving. If you have any debt, pay that back first. To manage debt levels, keep a budget and set yourself a credit limit. Always try to ensure that income is greater than spending to avoid any unnecessary debt. If you're taking out a loan, paying back that loan and any associated interest payments become part of your non-discretionary spending. Pay it back first. High interest rates can become a very dangerous game. Now, if you have some extra money left over, you may want to start saving. But before you go ahead and do so, assess the level of risk you're willing to assume. If you're a complete risk-averse investor, stick with guaranteed investment certificates or government T-bills. While they provide lower returns on your investment, they are the safest bet. Also, stay informed with the macroeconomy to see whether or not this is a good time to invest in some other securities. Or, for example, what's the employment outlook in the industry right now? Is it in a growth stage, decline stage? Keep in mind that investments will tie up your cash flow, so plan to stay flexible in case of any emergencies. And finally, never hesitate to contact your financial advisor. Work together to formulate a plan to start meeting your goals. Remember, it's never too late to start managing your finances. My name is Marco, and I am a third-year student in the Accounting and Financial Management program at the University of Waterloo. I believe I deserve to win this award because my education is dedicated to financial literacy. But aside from this, I am also a very deserving candidate because I am passionate for finance. In my spare time, I keep up to date with financial information through my subscriptions of Canadian Business and Money Sense magazines. Currently, I am also a teaching assistant for a course called Introduction to Business in North America, where one of the modules focuses on financial management of a company. I am passionate for sharing my knowledge and understand the importance and value of financial literacy. For this reason, I believe my values align closely with those of the CAAMP Foundation. In the future, I hope to be able to continue sharing my financial knowledge with other people, and certainly this award would be a very helpful kickstart to a great future.
Bob and Ted bought their houses at the same time, with the same features, and paid the same price. Ted used the services of an accredited mortgage professional. Bob didn't. When financing a home, an accredited mortgage professional, or AMP, can help. An AMP will explain all your mortgage options, provide expert advice, and provide you with mortgage peace of mind. Looking for a mortgage? An AMP will find the best solution for you. When you think mortgage, think AMP.
The Canadian Association of Accredited Mortgage Professionals, the foundation of Canada's mortgage industry, empowering Canadians to become responsible homeowners. In 1994, Canadian mortgage professionals from across the country came together with a singular vision to build a professional association that spoke with one voice and was reflective of all sectors of the Canadian mortgage industry. Today, CAAMP is that voice. From coast to coast to coast. 12,000 CAAMP members empower Canada's growth. With $1 trillion in mortgages outstanding, we are a pillar of the Canadian economy. CAAMP is recognized both at home and abroad as the authoritative source for the Canadian mortgage marketplace. CAAMP continues to promote positive change in our industry. Our members help Canadians make their dreams of responsible homeownership come true every day. Owning a home is an important accomplishment, but it means so much more than bricks and mortar. If you ask most people what their home means to them, they'll talk about family, watching their children grow, celebrations with friends and neighbors, birthday parties in the backyard, special memories, and a feeling of belonging to a community. That's what homeownership means to most of us, and that's what we are helping to provide Canadians. When the time comes to finance a home, consumers look to CAAMP members and the Accredited Mortgage Professional designation. The AMP designation signals to the buyer that their mortgage professional is well-trained, well-informed, and committed to upholding the highest ethical standards in our industry. In partnership with Credit Canada, CAAMP will empower Canadians to make wise financial choices with the creation of a financial literacy project for Canadian homebuyers. Financial literacy is key to personal financial success. It underpins a healthy economy and a stable mortgage market. As CAAMP grows and evolves in the years to come, we look forward to meeting the challenges of our ever-changing industry. Through education and advocacy, we will continue to enhance our leadership role as the voice of our industry, and we welcome every opportunity to assist Canadians with making the most informed mortgage decisions. CAAMP members are committed to raising the bar on professionalism. As a CAAMP member, you play a fundamental role in building the strength of our industry and our country, empowering Canadians through education and advocacy. We are the Canadian Association of Accredited Mortgage Professionals.
The Accredited Mortgage Professional is Canada's designation for mortgage professionals. Being an AMP enhances your reputation as a mortgage professional and demonstrates your commitment to the highest standard of performance. The AMP provides added value to borrowers and mortgage industry professionals and can help grow your business. An increasing number of Canadian mortgage consumers are becoming more aware of the AMP designation and are seeking the services and advice of an accredited mortgage professional. This past year marked the reinvention of the AMP logo and tagline, "Working for You," which places more of a consumer focus on the brand and better depicts the role of an AMP. CAAMP is committed to supporting and promoting the designation and invests over 90% of AMP dues back into its promotion. Raising public awareness of industry standards and enhanced professionalism bring value to the designation, to the association, and to the industry as a whole. To learn more, contact amp@caamp.org. This year, Canada Guarantee experienced significant growth as demonstrated by the successful relationships established with Scotiabank, RBC Royal Bank, and ING Direct. Canada Guarantee continues to expand its national presence with account executives and regional underwriters offering dedicated support and local market expertise. In addition to ensuring every call to the National Underwriting Centre is answered directly by an underwriter, Canada Guarantee offers extended business coverage to provide increased support and improved turnaround time for applications submitted after standard business hours. Whether in the office or on the road, Canada Guarantee app offers mobile access to valuable tools and essential product information conveniently available through your iPhone, BlackBerry, or Android device. As the only 100% Canadian-owned private mortgage insurer, Canada Guarantee is committed to elevating the home buying experience for lenders, mortgage professionals, and consumers alike. Discover how value-added solutions, comprehensive training, and the dedicated support from Canada Guarantee's experienced team can help you succeed. With unstoppable growth since inception, Dominion Lending Centres has grown to a network of members that span from coast to coast. With hundreds of street front office locations positioned across our beautiful country, we have become known as Canada's national mortgage company. Inspired by opportunity, driven by leadership, there is only one Dominion Lending Centres. People join Dominion Lending Centres for all sorts of reasons: the compensation, the technology, the training, the vision, the brand, and more. And with new exclusive programs such as Enriched Academy, Plan B Mortgage Services, unsecured Visa cards, and the Dominion Charity, we are innovating every day. Make your career your success story. Today is really when your new career begins. Contact us to learn more. We look forward to serving you. Genworth Canada welcomes you to the 2012 Mortgage Forum. As Canada's largest private mortgage insurer, Genworth Canada is committed to making homeownership more affordable and accessible for Canadians. Working together with brokers and lenders across the country, the company has helped more than 1 million families achieve their homeownership dreams. Genworth Canada is also committed to helping homeowners stay in their homes during difficult financial times. Their Homeowner Assistance Program is recognized as the best in its class, having helped more than 19,000 families avoid foreclosure through innovative workout solutions. Through homeownership and financial literacy education and active support of many local and national charitable causes, they continue to be a significant contributor to the health and prosperity of communities across the country. To learn more and to have a tour of their new website, visit the Genworth Canada booth. Be sure to enter their annual iPad draws. The success of any mortgage professional lies in their knowledge, skills, and competency. As the foremost provider of mortgage-related instruction, CAAMP plays an integral role in providing timely and relevant training and education opportunities. CAAMP's courses are all accessible through Mortgage Campus, the convenient and comprehensive resource for quality, cost-effective professional development courses. Designed to help members increase efficiency and productivity to stay competitive, Mortgage Campus courses include provincial licensing and relicensing, ANP pre-accreditation, practical brokering, and compulsory and professional development continuing education courses. Mortgage Campus is an essential mortgage education resource designed to ensure mortgage professionals have the knowledge and capabilities necessary to understand current business trends and changing industry regulations, adapt to an ever-changing marketplace, and maintain a competitive edge through Mortgage Campus. Course content is updated regularly to reflect changes in the industry, so visit the site often to stay up to date. Mortgage Campus, setting the standard of mortgage industry excellence. Visit us at www.mortgagecampus.org. Scotia Mortgage Authority provides you with prompt, personal service, combined with access to a wide range of innovative products. We are solidly committed to the mortgage broker business, and that dedication to our broker's success manifests itself in faster approval and adjudication times, and service that will deliver results to your clients. Scotia Mortgage Authority believes that you should be rewarded for your business. As one of our top brokers, you'll benefit from the personal service of a broker relationship manager, a one-stop relationship that will save you time and effort. On top of outstanding service, you will have the full suite of Scotiabank's mortgage products at your disposal, including the popular Scotia Total Equity Plan. You're among those at the peak of a competitive field, and you've worked hard to get there. By choosing Scotia Mortgage Authority, you'll be partnering with an organization that will work equally hard to ensure your continued success. Join us. Succeed with authority. Street Capital believes mortgage professionals are an integral part of the mortgage process. Street Capital is 100% committed to securing long-lasting, valuable relationships with mortgage brokers. Street Capital status level brokers enjoy a service level commitment that includes dedicated sales support, personalized underwriting, and funding services, as well as access to discounted pricing, street rewards, and street pricing credits. Additionally, Street's competitive compensation plans and dedicated underwriting provide support to brokers to grow their businesses. With 3 great compensation models for status brokers to choose from, Street is providing opportunities to earn income now and later. Choose from traditional Street, loyalty upfront, or loyalty trailer programs. With the launch of the Street Options program, an uninsured program for borrowers who don't meet traditional lending guidelines, Street Capital is now providing brokers with a more comprehensive product suite. Street Capital, broker focused, broker loyal. Verico is Canada's #1 mortgage broker network with over 190 offices and 2,300 plus mortgage agents who originate over $12 billion in annual loan volume. Our brokers collectively originate approximately over 45,000 plus mortgage transactions per year. Verico is comprised of the top professional and influential mortgage companies and originators in the country. The Verico Mortgage Broker Network prides itself on our core pillars of excellence, professionalism, and ethical standards, and as a result, we have earned a reputation that is coveted in the industry. Find out why the most respected brokers and influential mortgage companies in this industry are members of the Verico Network. Talk to us. You'll be impressed.
Hi there, and thanks for tuning in to CAAMP TV, powered by TMG, the Mortgage Group. This is our last panel of CAAMP 2012 Mortgage Forum, and we're pleased to have the heads of some brokerages here with me today. Today we've got Grant Thomas, founding partner of TMG, the Mortgage Group, Colin Dreher, President and CEO of Verico, Gary Morris, President of Dominion Lending Centers, and Michael Beckett, President and CEO of Mortgage Alliance Company of Canada. Thank you, gentlemen, for joining me today.
Thanks, Dan.
So, I know that you guys already had a panel today, but some of the viewers have not had the opportunity, so I really appreciate you guys coming back. Why don't we just start off? What are you guys seeing in your markets, and where do you see it heading over the next 6 months?
Want me to start?
Well, you can go ahead and start, sure.
I'm glad you were the last panel. You obviously saved the best for last. We really appreciate that. But as far as the market's concerned, we're seeing the market's going to be fairly soft for the next 6 months. Hopefully the second half of next year we're going to see a pickup. But for us as brokers, the market shouldn't really matter too much. We got to get back to basics, get back to fundamentals, and start working on finding ways to develop good, strong client relationships. With what's happened with the regulations, it's actually an opportunity for brokers to provide solutions that we know that the financial institutions aren't going to be capable of. And that makes me pretty excited because I think we can do a good job. We've proved in the past we can do it. It's just the market's taking a 10-year back step, and I think we'll be there to capitalize.
Yeah, I don't think that we've really seen the true effects yet of the new reg changes and guideline changes. I think that in 6 months from now we're going to have a better understanding. I mean, I can't help but believe that we're going to definitely see a slowdown. It's going to impact us, but from my perspective, anytime there's crisis, there's opportunity. So you got to understand that as it gets more difficult for business for sale, for stated income, for first-time home buyers, for people to qualify based on the reduced amortization terms, comes opportunity. And it's also very challenging and very difficult for the banks. They're having a harder time getting those same approvals. So I think that there's actually going to be more consumers seeking out mortgage professionals looking for solutions. Is there a challenge in front of us? Yes, there is. But can we power through it? I absolutely believe so.
Well, Gary, I agree with Gary and Mike on their comments. I think we are going to have a softening of the market as part of the cyclical part of it's imposed by regulatory changes. But in any event, I can't add any more than you two gentlemen add to that because I fully agree with that. But I would say that people need to adjust their thinking. Their expectations perhaps they've had up to this point. It's been very buoyant market, very good for everyone. So I think it's time to recalibrate your expectations and get back to the basics of business. And if you do that and learn to adjust the changes that we talked about, I think you do very well. But I think it's time for the professionals to step up, as you say, Gary. And I think that if people focus on that, they do very well. But I do believe what they said this morning in the panel, the economy panel, that we're probably in this trench for quite a while. So adjust to new expectations.
Yeah, I just add a couple points that I might add to what you gentlemen have said. Is that I know in our business we've cleansed a lot. There's a lot of brokers that didn't need to be in the business, shouldn't be in the business, weren't necessarily there. So the opportunity for the real professionals, the guys, is still there because the whole industry is going to rise right now.
Absolutely.
Our whole industry is going to step up its game. Good people, the people do a great job, will have more opportunity because there's brokers that were trying to be brokers, attempting to be brokers, shouldn't have been in the business or couldn't make it. And now those have come out. There's those deals to be done now by really good professionals. So lots of opportunity. A lot of opportunity.
Well, and I think you bring up a great point there, Grant, and not that I'm favoring you, as some may have joked about, but...
We were serious.
Okay, well anyways, what are we going to do as an industry and as brokerages to ensure that we're refilling those that maybe we're getting rid of or are leaving the industry and bringing in the newest and brightest?
Our philosophy as far as the industry is concerned is that you can't get from 25 to 30 or 40 or 50 with the same people. You can enhance what you've got, but to really push our industry forward, we got to get good, qualified people to become part of our organizations. And we've had a lot of success in getting road reps from banks, people that have the experience, understand a mortgage, they don't understand a broker's attitude or a broker's options. But I think that's a great market for us to look at new people. They've got a lot of the skills that we need already built in, and it becomes a great opportunity for them to build their business. We've had lots of success there. And one of the things that we're finding is that we're looking at We're looking at recruitment more like insurance companies or companies like Investor Syndicate, where they're looking at high school graduates or sorry, university graduates, looking at university graduates and going to career fairs and presenting opportunities.
We're starting early, eh, Mike? The high school grads?
Yeah, these young men and women that have never been advised that there's an opportunity to make good money and build a good business in sales.
Of course. Can I jump on that for a moment? I think that one of the things Grant talked about today on the panel was the profitability structure within the industry, the healthy infrastructure of the industry. And I think in these times, and Mike, I fully agree with you, there's a great opportunity to bring the right people in and let them understand this is a profession. This is a huge opportunity in the marketplace for them, and they could build a family and a career out of this profession. But to do that, they got to learn the right steps. And based on that factor, they've got to have the right compensation levels as they move their career up. So they need to start at a lower level of expectations, and as they progress and experience and educated, then they can move up traditionally to higher levels of compensation. But they can't expect that from the start. So if we look at a profession, I think we've got a chance to bring in the right people, and that makes it allows us for the right profitability, to put the right emphasis and service and education back to help those people have a career.
Yeah, I mean, I think one of the most important things for our company and for our industry is organic growth. And if you look at the real estate industry in Canada, there's about 88,000 realtors in Canada. And, you know, I saw the numbers recently in our industry, there's about 14,500, but there's, you know, just over 9,000 mortgage agents that actually did a transaction last year. So I look at a pure number of about 9,000 agents. So there is a monumental opportunity for growth, for organic growth in all of our businesses. And I think that we have to continue to market. I mean, one of the things that our company's done is that we have recently launched the DLC Learning Academy, and it is a pre-licensing course where we are going out to the consumer directly, and we are actually taking them, whether they're a mobile mortgage sales force, whether they're a sales professional, we're bringing them to our space. We're actually giving them a 6-week course. We're preparing them for the actual education requirements, so when they write it, they come out of the gate hot, they come out of the gate prepared, and they actually have a sales cycle in place, they have a CRM in place, and they have a community that they've gone through the course with. And I think that we're going to find a lot of companies are going to do the same thing. Honestly, we can't do what we need to do in Canada. We can't be leaders in the industry. We can't compete with the actual banks and garner more market share unless all of us in this room really, really focus on putting more organic growth and more good quality people who want to be in this business, who want to invest in themselves, you know, and making it easy to bring them on board. So that's a huge focus of ours.
And Colin, you talked a little bit on compensation there and the changes that, I mean, there's changes happening in the industry with regards to compensation. I'm not sure if you're all familiar, but the US has now come down and actually regulated compensation for brokers to a flat fee in some marketplaces. I know they regulate it, it's not a national regulation, but do you see anything like that possibly coming down from the regulator in Canada?
I don't know if I see a regulated commission structure or not. I know that a couple of the lenders have decided that it was an opportune time for them to reduce commissions a little bit. But when we're talking about a 5 basis point reduction, it's not a significant amount. I think one of the things that we have to be careful about as brokers is the fact that if we keep focusing on rate, and lenders put out rate specials and it's reduced commissions and brokers jump all over it, it's almost like we might be encouraging the lender to look at the fact that says, well, you know, if I only pay this much, but the rate's good, I can still get a lot of business. I think we're almost deprofessionalizing ourselves, and we just have to be careful about that. I'm not saying that, you know, don't take rate specials and don't do rate specials. I'm just concerned that it might be sending the wrong message to our suppliers when brokers jump all over rate specials.
I don't think that we'll see a flat fee kind of compensation model. It can't be regulated. Certainly the financial institutions can make adjustments, but let's be fair. The mortgage broker does a great job for their suppliers. They supply great customers to them. And if our efficiencies were higher, they're more profitable. So sometimes it's not just the amount of volume, it's the efficiencies related to the volume. So if we can give them good customers efficiently, then their profitability stays reasonable. Then there will be, if there's any adjustments, it'll be minor adjustments. You know, just to readjust to make them, you know, more balanced in terms of compensation. But there's no reason to change compensation levels if we provide good service to our lenders.
Yeah, I think it's going to be a long time before we see regulatory focus on capping our commission structures. I think that Canadians are conservative by choice for the most part. I think in the US it was a totally different animal. So what you had in the US is you had people actually, it was a net branch model, totally different model, but you had people actually getting overrides from the lenders for bringing the business, and they had those very same people saying to the consumers when they asked, what am I paying for your service? You're paying $200 or $400 or $500. And so it started to get out of control. I don't know if that's going to take any legs or have any legs in the US, but from our perspective in Canada, you know, I think there's a very, very long runway. I think that we're still fairly infant in our business, and I think together, you know, I think that we're going to build a better relationship with our lending partners, with our governing bodies right now. We're going through a very, very difficult period, but I think that it's stimulating some of these very conversations, this very dialogue, and I think that we're not going to see too much rate compression or too much commission compression outside of what we've already seen.
I'd just like to add with respect to the U.S. market, Dan, that there, you remember, they added their fees into the spread, and so there was a lot of unnoticed spread, you know, income and commission spread. So your rate, they could adjudicate the rate. The rate was 3%. They added half a point a year in, and got paid that way. So
they actually paid you, Grant, did they not? If you charge more, they paid you more.
That, exactly.
US, right?
Well,
Right?
you had the opportunity to actually add it in,
which
so
is somewhat similar to what some banks are able to do currently.
Yeah, well, we encourage them to do it by way of buy downs, and we don't encourage that, of course. But in the U.S., it was you just added on the top. This is your rate that you need to sell. It's 3 points. You want to make this much money, you charge another. You add more points into the rate, and they would get paid. So I don't think we're going to have that type of regulation here because we just don't do it that way. Yeah.
And as far as our partners, I mean, our lending partners are just as much of our livelihood as our clients are to our livelihood. You know, what do we do to ensure the success that we don't see others exiting the industry? Thoughts?
I think it's a bit of a two-edged sword. Competition is a very, very, very valuable thing because competition creates efficiencies, creates performance, it reduces rates. So competition is a very good thing. We have to be a little bit careful when we're dealing with our lenders because it's got to remain a profitable environment for them. When I say a profitable environment, investors have choices where they want to put their money, and it's not that they're not necessarily making money in the mortgage business, it's just that they could use that capital someplace else and make a little bit more. So as brokers, we need to be sensitive to all the things that affect our lending partners. We need to have conversations with them about all the things that affect them. You know, we're not only talking about their underwriting and rates, and we need to look at it from the investment side, you know, where they get their funds, cost of their funds. The partnership that we really need to develop is we need to understand that all the pain that our lending partners have, and our lending partners have to understand the pain that we have as brokers. And what a true partner does, you try to understand and ease their pain, and they try to understand and ease ours, so we can still deliver, you know, good competitive product that's a great experience for the consumer.
But when you say at the end of the day, banks want to get their money out. Okay, they do want to get mortgages out. And so the fact that you provide them a good customer, they're not going to turn it away. So it's just incumbent on us to make sure we provide them good customers. And why wouldn't they want to deal with us, no matter what the circumstances are?
Right. So, you know, one of the things that lenders will come, lenders will go. Right. You know, these lenders are driven on profitability, on shareholder returns. They're going to be in markets. They're going to be, you know, out of markets. You know, some of the banks that have left, there's been some rumors, some of them are potentially, you know, looking at coming back into the market. We're going to see some of the U.S. lenders potentially come back. You know, you have to understand that when you have, you know, stakeholders and shareholders, you know, the Canadian housing landscape in general right now and the Canadian economy is not a favorable place. It's not a favorable place to be right now. You know, so I think you'll see that as we start getting some answers around the unsettlement in the U.S. market, and we start seeing some. We start seeing the Eurozone, crisis come to a head. The U.S. election is just bypassed. I think you'll start seeing some stability And when we see that stability, I think you'll see more lenders come in. What we have to do as a company is that we have to make sure that we go out of the way to support our lenders, to understand what their needs are, to deliver those efficiencies, to listen to what they're saying to us, and to be good, profitable partners. And we have to work with our agents and our owners, and we have to make sure that they understand just how critically important it is to deliver those profitabilities and those efficiencies to those lenders in order to sustain a good, long-term, fair, and equitable relationship.
Yeah, I totally agree. I think it's so important for us as industry leaders and as our brokers to go out there and help make that lender efficient. If you make that lender efficient and you do a good job and they're having a little bit of fun doing their job and supplying the service to you, they're going to want to do things for you back. And if it's a good experience, they're then going to start thinking about other products. You know what? Those guys do a great job and it's good doing business with them. Let's give them something else because they know what they're doing. Let's give them another product. So, we every time we do a deal, we talk to an underwriter, we talk to our BDMs, we should be thinking in those terms of taking care of them, treating them right, being respectful, and helping them do their job in a really cool way so that they go home at the end of the day saying, you know what, I had a pretty good day. And they need it, because everybody needs that. And I just like to see more of that. I'd really like to see our...
It's a bit of a motherhood issue, but it's absolutely, I think we all have to buy into that.
Yeah, for sure.
Want to build a little bit on Gary's point there, where the other players that are not in the broker market currently, I mean, is there a way for us to, drop the company line, the company walls, and work as a partnership all together to get those remaining players actually distributing directly to us? I know that some are involved in a wholesale capacity or supporting in some way, shape, or form, but for us to have the likes of Bank of Montreal, HSBC, Royal Bank actually offering us a direct product.
I don't think we have the ability to affect corporate strategy in those situations, but what we can do is create an environment that would be desirable for people to re-enter the market. And that desirability comes from being professional, being efficient, being cost-effective, being reputable. And I think if we work together and create an environment where they see it as a good, stable, solid, again, profitable
absolutely,
business
Mike,
opportunity.
I absolutely 100% agree. I think if you can see that moving the needle, we're doing all those things, and we're actually moving the needle and affecting the consumers, why wouldn't you want to participate in that? If you're doing a lousy job, stay away. Doing a good job, I want in. So we can attract them back if we can do better at what we do. We do a great job now, but we can do better. And I think that others will come back, as you said, other lenders will participate. So I think we have a good opportunity here to show how good we are. So I think we should take this kind of adjustment in the market as an opportunity to step our game up, show what we can do, become more professional, more educated, and attract new entrants when the market starts to turn back into the business. So I think it's a big opportunity. I agree with you on this point.
I've got a story to tell. If you'll let me sit down with their bank executive, I've got a great story to tell because I can go in there and show them data, how we've improved our efficiency and our funding ratios and the quality of our clients. We're starting to get that data. And it'd be pretty hard, for a Bank of Montreal executive to go, well, we don't want to participate in that because it's not that efficient and it's costly. But we actually have some. We can go in there and show them that it is efficient. It is friendly. We're funding, 78 overall funding ratio, this type of thing, and that's important. And so now we have a story, and we're getting better data. Our lenders are getting better data. We're doing a better job as an industry. Our brokers are doing a better job. And every time we build that efficiency, we now have something to take back. And I guarantee you, they're going to be interested in it.
Yeah, I would add to that. I think at the end of the day, the more divisive we are as broker networks, the more divide and conquer mentality we're going to see from the lenders. I think if we do a better job and if we all reach out to the consumer and educate them just on what our value proposition is and the fact that we give Canadians choice, I honestly think that as we focus on improving our market share and we get to 25 to 28 to 30 to 32 to 35% market share, let's face it, these FIs want to be in the space because, when we originate mortgages, they have the ability to cross-sell all of their products, and they are much deeper than we are when it comes to cross-sell. I mean, all of our companies are trying to do different things right now, and bundling services and adding different things to our networks that are going to make our relationships deeper. But I think the stronger we get as a broker community in Canada, the more market share we get, the hungrier and the greater the appetite for some of these other banks to get involved and get back into our space.
Well, and kind of alludes to a little bit what we saw in the Merits research, which is what I saw and I was shocked by was that, and I believe the number was 44% of brokers believe that they don't own their client. I mean, that was shocking to me.
It was shocking to me too. It's one of the attitudinal things that I think we really have to work on as far as the environment's concerned. I think a really professional intermediary understands that they create a relationship, and the value of the relationship isn't the value of the deal. The value of the relationship is the extended life of your relationship with that customer. And mortgage professionals need to think about that once they do the first transaction, if they do a really good job, they're entitled to do all the rest of the transactions. So for only 44% of brokers to think that it's their customer, I'm shocked, appalled, and disappointed, and it also points to the fact that we all have to work on making an attitude change in our business.
You know what the interesting point of that survey was on the other side of the coin? 37% of lenders say they don't think it's their client either. But I would suggest that if you ever ask the heads of the financial institutions what their answer to that would be, 100% is, that's my client.
So my response is different altogether. When it comes to who owns a client, as far as I'm concerned, the client owns a client. And it's our job to build a deep relationship with that client, to communicate all the way through the life cycle of the loan, to start communicating before we've even built the relationship with them. You know, a lot of us stay in touch with past customers, but what about friends, family, neighbors, uncles, cousins, people that we know, parents from the sports teams that, you know, we see every Sunday? What about putting them into our distribution, into our CRMs? What about educating them, you know, week after, you know, month after month on what we do, so that when it becomes time for them to look for a solution for their mortgages, they already know what we do. I mean, we have to be as aggressive in our companies at retention as the banks are. We have to start communicating early. We have to start, you know, building that relationship all the way through. And I think
from
that
hello to the end.
I'm sorry.
From hello to the end.
Right. From the
right. To the end.
Exactly, from the beginning to, you know, from the beginning to the end. And I don't know that we do a good enough job as an industry, but certainly in our company, you know, we're really, really focused on proactive education, even before the customer is maybe seeking out our services.
Yeah, I just think as individual brokers, and we talked about this in the panel earlier today, had a comment that we don't take enough time, you know, our brokers are thinking about doing a transaction. We don't take enough time to actually make sure a customer understands what we do and how we do it. Because that's a story that they can then tell if they truly understand what we do. That we're there to support them, we're there to take care of their interests, we're there to shop the market for them, to investigate what is it they really truly need, not just a rate. You know, just coming here for a rate and a mortgage. So we need to educate every one of our customers better, but that takes time, and you have to spend some time in doing that.
But we have to change the mindset a little bit, is that we're transaction based. I provided a mortgage. No, I'm customer relation based. You're a customer, you're a person. I want to interact with you, as you said, all the way through the process. So the fact is, we're in the people business. We're not in the mortgage business, actually. That's our product, but we're in the people business. And as soon as we start thinking that every person is a potential relationship I want to have for the rest of my life with this person and provide them my products, then you'll start moving in a different thought process.
Just to get back to the point about the 44% and the customer aspect, I agree with Colin 100%, and I guess the best way in my mind that we could clarify this with our networks is the fact that if you talk to a broker, generally speaking, brokers like to talk about what kind of volume they do. If you talk to a lender, they talk about two things: number of customers and assets under administration. They look at the business differently than we do. And that's the attitude that we need to change. Is we need to start talking about the number of customers, not the volume that we did last year.
Very good point. Very good point.
Well, and it's interesting. You talked a little bit about it. Is this whole idea of people are more transactional and people are more focused on just, I get you the absolute best rate, which it was interesting when I was speaking with the Australians, they can't even advertise the word best.
Neither can we.
No.
But through technology, we're seeing it everywhere. We've got rate websites, everything, and in some instances, that's actually taking away from the value that...
It degrades the professionalism of our industry, is what it does.
And to Grant's point, you're not able to tell that story, which is...
Actually, one of the really interesting points that Grant made when we had the panel before was the fact that a lot of our brokers don't even see their customers, and they think they're being efficient by not seeing their customers, but they're actually losing an opportunity to build a relationship.
Yeah.
And I think that's very, very important. Competition is good, right? I mean, having the rate shopper sites and all that sort of stuff, it's great, it makes sense. But we as brokers, we really need to understand the fact that it can't be about the rate. It's got to be about the value add to the rate. And that's what we need to focus on, is the value add to the rate, not the rate. If we focus on the rate, then we'd be one of those rate shopping websites.
I think Dan, we really got to. You got to pick your horse and you got to ride it, right? We have 25% market share, in Canada. So brokers deal with 25% of the Canadians. There's going to be all different kinds of models. There's going to be flat fee models. There's going to be direct consumer models. There's going to be rate auction sites. There's going to be lowest sites. There's going to be full service sites. We got to decide what we do, and we got to do it better than anybody else. So if we're full service and we are education and we are proactive communication, we got to be very, very good at that. I mean, customers don't care about us until they know how much we care about them, plain and simple. So I don't look at any one of those rate sites, any one of those low interest rate programs as a threat. They're always going to get a certain percentage of the market. There's always going to be those Canadians that just say, I don't care about anything else, lowest, bottom, cheapest rate. And those may not be in our wheelhouse. Obviously, we're going to look at them. There's going to be people in our space that have the capacity to deal with those kind of clients. But I really believe that niches create riches, and we got to figure out what we're good at. And if it's being a consumer advocate, if it's education, if it's building that trusted advisor relationship, if it's outside of being transactional, I think that's where we have to go. Because if you're all about rate, it only is in most cases about a one-time transaction. Next time that mortgage comes up, and when they break that mortgage, they're going to the next guy. They don't care who you are, But when I have a deeper relationship, if I'm dealing with a past customer of mine that I've dealt with on 2 or 3 different occasions, I got to tell you, and every mortgage professional in Canada that's been in the space is going to say that rate comes into the conversation, but as long as we are in the ballpark, right? As long as we are close, the value and advice and certainty that we give them is far more important.
Dan, one of the models is when Rob from Moritz gave his presentation, he talked about his broker, talked about his relationship, talked about how he's going to give his daughters, the advice, and that's the kind of relationship brokers should have with customers, right there. That epitomizes it at the end of the day. That's what we need, that kind of feedback and response. And if consumers can talk about us like that, we're winning.
Totally. Now, I'm conscious of time here. I appreciate you guys all supporting today. I guess if you had one message to, not to the industry, but to the individual broker that's out there pounding the street, what can they do to ensure the viability of all of our organizations, our industry, all of our lenders, the brokerages at the end of the day? If there's one message you had for them, if you could share that.
You want to start with me?
Well, we can start. We'll start the other way.
I got 2 messages. Be nice to your lender, and start thinking about customer relationships instead of mortgage transactions.
Okay.
Yeah, if I had one message to our brokers, I think it would probably be to. I got a few things going through my head, but I think it would probably. Look to deepen the relationship. Look to make your customers aware that it isn't about rate, it's about building much more than that, that trusted advisor relationship. I would find a way to to promote other services, the more cross-sell opportunities, the deeper relationship that we can build with our clients, the more loyal and committed they are to us. And the other thing I'd say is really show leadership. I fly a lot. I fly 110 days a year. But when I didn't fly as much, I was terrified of flying. And I remember when I hit turbulence in the airspace, an uncertain time, I would look to the stewardess. I would look to the staff. And if they were like in sheer panic mode, parking the cart and sitting down and were worried about the flight and you know what, like I would be very unstable. So when I look towards them now and I see that they're calm, cool, and collected, it's okay. I know we're going to get through it. We're in uncertain times right now, and it's okay, and we're going to get through it. And I think our mortgage professionals really have to work hard to drive that message home to the average Canadian who is hearing bad news, negative press. Because remember, in media, if it bleeds, it leads. I said earlier on the panel today that you never hear good news. You never ever hear that 1,000 planes landed safely today at Pearson International Airport. You only hear of the cuts, the devastation, and the losses. And I think that we have to show that leadership and that stability to our customers for them to really believe emphatically that we know what we're doing and we are their trusted advisor.
I'm not going to take any comments away from Michael or Gary. I would just say, really, you've chosen to be in the mortgage profession. Treat it as a profession. Be a professional. Get up every day. Focus on what you do. Ensure that you give full service to your customers. They will return in kind. And you will succeed at what you're doing. And to the point that we all believe in, it is about the journey. So learn from every experience, learn from every obstacle. Stay committed and be professional, and you will succeed.
For me, you know, I would just like our brokers, everyone's brokers, to really appreciate these guys, their leaders, their development managers, the industry partners, and our underwriters, the whole team. Appreciate them very much because we're all striving for the same thing, to be really good at what we do. And I would say treat them the same way you would like to see your mom treated by everybody she runs into. And if we do that, we'd all be in a little bit better place.
Good point.
Yeah.
Good end.
Yeah, there it is.
Well, I love you, Mom.
Yeah, I love you, Mom.
Well, thank you everyone for tuning in to CAAMP TV, and thank you, gentlemen. I know it's been a long day, and appreciate you guys coming out. And we will see you all next year at Mortgage Forum in Toronto.
Thanks, Danny.
Thanks, Dan.
Very good.
Thanks, Grant.
Thanks, Dan. Thank you, guys.
Thanks, Colin.
Appreciate it. Michael,
Good night,
sweaty hand. I don't know why I've got a sweaty hand this
Thanks,
time.
Grant.